Hi, my name is Roy Rumbo. I'm an adjunct accounting professor at the University of North Texas. I teach intermediate accounting 1 and 2, and today's lecture comes from intermediate accounting 1. It's for my accounting 3110 students at the University of North Texas. But this is going to be on YouTube and available to anyone who maybe needs a good sleep. Who knows? But anyway, I do hope to. I had a long accounting career before I went back to school to teach, and kind of my chance to give back, if you will, to teach accounting. And so I love making these boring presentations publicly available. So if you like them, let me know. And if you see some things I can do to improve, let me know. Although I don't know if I'd spend the time to re-record all these lectures. It's definitely a lot of work. So today's lecture is on accounts receivable. And I do use the McGraw-Hill textbook, Spiceland, Nelson, and Thomas. It's a great textbook, and I'm borrowing their materials today. And certainly want to give McGraw-Hill credit for that. It's a great textbook, love it. And you can see the slides are pretty good too. So definitely helps me out. So with that, let's get started here. I'm going to share my screen and go right into, well, it's a cash and accounts receivable. So this course is going to go right down the balance sheet, and we're starting at the top here on the left side with assets, and it's cash and accounts receivable. All right, so we talked about this earlier in the balance sheet presentations, that cash on the balance sheet includes both cash and cash equivalents, because no company, if they have, and there's some companies who have billions of dollars just sitting around in cash there. You think about Microsoft and Apple and some of these large companies that are very cash flow positive, and they maintain a lot of cash on their balance sheet. Well, they don't want to just sit around not earning interest. So they, at a minimum, if they don't put it in the short-term investments, which would not qualify as cash, they put it into things that we classify as cash equivalents. So what are cash equivalents? Let's just take a look at this. Two important things here on this slide. Little risk of loss. Therefore, common stock, which we refer to as equity, not, there's always a risk of loss. There's much more volatility in equity investments than there is in bonds. So we're going to think here of things like, well, right here, money market funds, treasury bills, commercial paper, that their value does not change much from day to day, and always lower interest, but at least it's better than zero if you're just sitting around in cash. Now, the second qualification, so risk of loss is the first. The second qualification, that the maturity date, when these things are going to come to term and be paid out, has to be less than 3 months from the date of purchase. So to think about that. So that's basically it for cash. So there you go. That's what you need to know. We'll show a little bit more, later, I believe. So we do want to have strong internal controls, and obviously we have whole courses on internal control later, but not as part of accounting 3110 here at UNT. But you want to just quickly address it, because there needs to be a lot of controls over cash. Internal control for public companies, to have strong internal controls is required by law. And auditors who are auditing the company express an opinion over the internal controls, and public companies management teams are also required to provide an opinion that their internal controls are adequate. And therefore, there's a lot of work done to support these opinions. One of the important internal control procedures that every company should have is a good separation of duties. For example, here, especially the handling of cash, you do not want someone who can handle cash and record the transaction for cash, because now they could record, hey, we received all this cash, and then they could pocket it, right? And they could play games with the books. That'd be maybe hard to find. What if they also did the bank reconciliation? So they have control of the whole process, so they can hide a theft of cash for a long period of time. So what we want to do is separate this out. Employee A opens a mail and looks at all the checks we've received and lists those out. Employee B takes the checks to another person who's responsible for the depositing the bank account, and that employee gives the check listing to the accounting department, where employee C enters the receipts into the accounting records. Now, it's very important here, employee C can never record cash. Now, I was a corporate controller, and it seemed like we always got cash in our department because, it was a very large corporation with multiple divisions. And so people say, I don't know what to do with this check. So they always generally bring it to me or someone in my department. And I'm talking about big checks, because this was a big company. And so we had one person there who would take those checks and deposit into the bank. But we went into the system and we did not allow, we precluded this person forever recording cash, any transactions to the cash account in the general ledger. And she was not allowed here. It happened to be a she, but it could be a he or she. She was not allowed to perform a bank reconciliation or have any kind of accounting responsibilities over cash. So we had a person designated for those checks that we just always received. We didn't want them. We said, take them back into your own division and record them somewhere else. We didn't like touching cash because we were the accounting department for the corporation. And so disbursements, when we're to the first slide, we were talking about receiving cash. Now, when we pay cash, we want to have some prevention to make sure there's no unauthorized payments. And so all disbursements should be made by check. So we know we have a record of how much was paid, who paid it. We can track that. There should be, before anybody in the company cuts a check, then that expenditure should be authorized by the person cutting the check. No, segregation of duties. That should come from a management person, and there'll be levels of authority of how much each person can be authorized to request a check. So usually have an invoice from a vendor and some operational manager has signed off. It'll come to what we call the accounts payable department, and they will check to make sure the right person has authorized this, and they will cut the check. And so, we want to make sure that all expenditures are authorized by the right person who has the authority to commit to those funds. Now, moving on, here's an element that we should think about here and pause for a minute. Every dollar of cash that's on our balance sheet must be able to be used for operational purposes. And that's why we use cash equivalents, because they could be sold in a matter of minutes and become cash that we could pay our bills with. Well, guess what? There is some cash that may have been restricted and cannot be used for operational purposes. Maybe the company has set aside a special bank account in cash for a future plant expansion. I've never seen that, but what I have seen is maybe there's by contract that the company has to set aside some funds for a special purpose. For example, maybe we have a large amount of bonds. Maybe we have $500 million of bonds, and the bond agreements require us to set aside some cash each year to be prepared to pay those bonds. So that cash is restricted, could not be used for operational purposes. It needs to be set aside because of the contractual relationship we may have due to those public bonds or private bonds, whatever, or a bank debt, whatever. So that cash is restricted. Therefore, it has a separate line item on the balance sheet, restricted cash. And so that's important to know. A compensating balance is a form of restricted cash. Whoever is loaning us money may ask us to put some amount in the bank as a compensating balance for a loan or a line of credit. And so that cash is restricted. Moving on now beyond cash to the primary subject for this chapter, and that's accounts receivable. So why do we have accounts receivable? Why don't we just only accept cash and checks for what we sell? Well, we wouldn't sell very much. And so business, especially large businesses, expect you to sell to them and give them some time to pay you back. For example, and there's a good business reason for that. You know, I work for Maytag Corporation, and we sold appliances to large retailers like Home Depot, Best Buy, going back in time, Circuit City, that's an old name, Lowe's, very large customers. And, you know, they don't sell it right away. So that inventory will sit in their warehouses and their stores, and then it gets sold. So they're saying, hey, I will sell your product, but you got to give me terms because I can't sell it the same day. You know, I'm going to have to hold some of your products in my inventory. And so it becomes, you know, kind of a way of doing businesses, if you will. If I can guarantee you this from personal experience, because as a finance person, I did not like having to give terms to customers. I wanted them to be short, pay us back, because I wanted the cash back in. I don't have any collection problems, things like that. But if you did not provide terms, you're not selling to Lowe's. You're not selling to Home Depot. I remember Lowe's, they actually wanted 90 days. I think they wanted 120 days to pay us back. And I just thought that was crazy. And it was a negotiated process. And I think we finally got to 90 days. And I think Home Depot or Best Buy, they only had 60 days or 30 days. And so there was different terms negotiated for each customer, and it's all part of the price. But again, if we did not provide customers with terms some opportunity to pay us later, well, we wouldn't have a business. And so accounts receivable is that amount that customers owe us for the fact that we have sold them their product. And it's a very legal right. It's what support. It's got an invoice, usually 30 to 60, and I've seen 90 days after the sell. And it is almost always classified as a current asset on the balance sheet. In this, I never had an accounts receivable that wasn't classified as a current asset. Now, there are times when customers could not pay us, and we said, well, give us a note. We'll get into notes receivable later in the chapter, but that's a much more formal agreement, and that will contain interest. It'll be for a longer time frame. So accounts receivable is a shorter time frame. Now we run into a lot of kind of nuances again with accounts receivable, and I've said all along, intermediate accounting is about the nuances, not just about the core accounting principles that you might have seen in an introductory course. Now we're going to get into some more complexity here. There may be a trade discount, and we may have a volume discount provided to customers who buy in large volumes, a lot of different trade discounts. And almost always we're going to have, and the textbook calls it sales discounts, but I've always called them cash discounts. In other words, if, and boy, again, back to my experience, I loved cash discounts because it provided customers with an incentive to pay us early. Now, if they paid us early, we were willing to take, you know, up to, like in this case, this was a 2%. That's what I've seen normally for cash discounts. Hey, you pay us in 10 days, we'll give you a 2% discount. That's called a 210 terms. 210 net 30 means, yeah, you can get all 30 days to pay me the whole amount. Or if you'll pay me in 10 days, I'll give you 2% off. Well, that's a pretty big discount. And, you know, customers will take advantage of that. But I see it as a win-win. The customer gets 2% off. They get basically a lower price, pay lower cash for the products they bought. But then we don't have any issues with collection. We've got the money in the bank, and we can move on. I don't have to have a credit department chasing them down for late payments and things like that. So definitely sales discounts, or in the other term called cash discounts, are a good thing. So how do we account for cash discounts? Let's just look at this, and spending time on this because my students will most likely get tested on this. And they either have what's called the gross method or the net method. In the gross method, we just go ahead and book the sale at 100%. Let's look at this cell here. Hawthorne sold merchandise at $20,000, and the terms were 210 net 30, meaning you pay me in 10 days, you get 2% off, or if you don't pay me till in those 10 days, you got to pay the full amount, and you get 30 days for that. So 210, usually the end, 210 net 30. Very common expression in both accounting and in finance and business operations. So here, the customer did take the discount for $14,000. You know, they owed $20,000, but they took the 2% discount for the $14,000, meaning 2% of that's $280, and so that's 2% of $14,000. So they only paid $13,720, and then the remainder of that $20,000 was $6,000, and they paid that in full, and they paid it on November 4th. So that's the facts of the case here. Let's look at the two different methods for accounting for that particular type of transaction. One is the gross method. You just take, it's, you know, cash basis accounting really. I'm going to take the sales revenue of 20,000 and credit that and debit accounts receivable for 20,000. And then I'll worry about the payment later. First of all, does that sound right in accrual accounting? If you know that normally almost all your customers take the 2%, would that be correct? No. I know one thing, my auditors and the companies I worked in would not allow that. I used to argue, you know, well, it's in my textbook. And you know what they would say? Textbook is not GAAP, you know, and this textbook could do a good job. We'll see where they address this here in a few slides. And so in the net method, the more appropriate method, according to my auditors, you would say, hey, we think customers will take this 2%. And then in the history, they've taken the 2%. And so we need to record what we expect to receive, not what we want to receive, what we expect to receive. In this case, we kind of want to receive that. As I said, you know, we like cash discounts as a seller as well. And so we go ahead and take 20,000 and we take 2% off of that. What's 2% of 20,000? $400. And so we record this sale of what we expect to receive after the cash discount, $19,600 in receivables. Revenue, again, revenue recognition, we know we put the price of what we expect to receive in the future, remember from the last chapter, revenue recognition. So credit $19,600. All right. On October 14th, they pay us the $14,000. You remember, they still owe us 20, but they paid 14. And so under the gross method, now we got to record those sales discounts. And so we will, what is this? A credit of receivables. We reduced it for the entire 14, but we only received 13,720 in cash, and we're going to debit the sales discount. By the way, that is an income statement, normally as an offset to revenue in your income statement line item. So you really, most companies will have a, you know, gross revenue and another line called discounts, and then they'll have net revenue, and net revenue is what ends up on the income statement. So this would be an offset to revenues, a debit on the income statement, keep in mind. Now in the net method, we already assumed they're going to take 2%, so we're fine. So we just say cash 13,720 and receivable 13,720. Remember back here, we only have 19,600 in receivable, which was 98%. So we've already taken care of that 2%. So we're good in the net method at this point. Now, finally, the company pays the remainder of the balance, $6,000. Under the gross method, we're good. That's what we estimated. You know, we didn't assume they're going to pay, take the discount, and so we're good. You know, debit the cash we received for $6,000, credit the receivable. And notice the receivable 20,000 was set up here with the debit. Now 14,000's gone, and now 6,000's gone. So we've taken care of that entire 20,000. Now in the net method, we get the full 6,000, but we were only expecting 5,880 because we reduced that 2% with our very first. Let's go back in time again. We only put 19,600 in accounts receivable, and we've got to take 5,880 of it. That's 6,000 minus the 2%. And so we've got a credit here sales discounts forfeited, meaning we thought they were going to take it, they didn't take it. Guess what this is? This is going to be a credit on the income statement as income. And it will be up again, up in the revenue line item on our financial statements. Now, in both methods, you end up in the same place, the 19,720 collected. The issue is about timing, because if this, let's say this revenue transaction happened, it didn't happen this way, December 15th, and these payments for the next year. So these things could end up in different places on your financial statements. And that's what my auditors were concerned about. Because if that sale happened late in the year, and then the cash was collected in the next year, then we only would want 19,600 in our financial statements, what we expected to receive in our December 31st financial statements. So this gross method could be considered wrong. And here's the slide, gross versus net, which is correct? Well, sales revenue in the receivable should be stated at the amount of money consideration we expect to receive. The net method generally, typically reflects the amount we expect to receive. How do we know? How do we predict the future? We can look at the past. If on average, customers have always taken a cash discount, then we need to use the net method. And look at this, if you did the calculation on that, the annual effective interest rate, I want to get this whole calculation with you. The customer got a 37% rate, so they saved a whole bunch of interest costs by reducing that receivable by the 2%. And so therefore, it was just looking at the finance math there, looks like it's highly probable they will take this discount. And by the way, they should take the discount. Okay, sales returns. We're getting, and again, another nuance. And this can maybe throw some students for a loop here, but be careful with it, because our customers, almost all customers these days, get a right of sales return. And if you've bought a lot of stuff from Amazon, please don't tell me you've never returned anything. And I hate returns because I know how painful it is for the manufacturer, having worked for 2 large manufacturers. But guess what? When I get a shoe I bought from Amazon or from Nike or Asics, is where I usually buy my shoes from, then and it doesn't fit, it's going back. And so there's a right of return. And so we've got to almost all sales these days have a right of return. So we're going to have to account for this. And so we're going to expect a refund or credit to happen in a future period. So we need, again, because we're accrual-based accounting, we need to estimate, we're going to sell, let's say we sell $1 million worth of products. We need to estimate how much of that million might be returned. And guess what? We can do that again, just like cash discounts, because we have a history that, let's say 5% of these sales return. Well, then we need to reduce that $1 million revenue by that 5%, because not all of it's going to be good. It's going to be returned in the future period. But we need to be able to recognize it now. That's what accrual accounting is, right? So we know we sell that million in this accounting period, 5% of it's going to come back maybe in the next accounting period. We've got to reduce our revenues now and our receivables now. And so we're going to recognize sales returns. We're going to accrue sales returns allowance at the time of the sale, not later. By the way, if we didn't do that, here's an example. The customer sold $10,000 in December 21st, and they know that $4,000 is going to be returned. And if they didn't recognize that return, now in this case, all of it returned, we would have an overstatement of profit in 1 year because we should have recognized returns, and an understatement in the next year. And so again, it would not be a faithful representation of the actual numbers for the accounting period 2021. and our financial statements would be wrong. They would be misleading. They would not be relevant to people. So let's look at the accounting here. So you're gonna just kind of follow with me here on the facts here. So this company sold merchandise for $2 million in cash, and they sold the revenues were $2 million. The cost of goods sold was $1.2 million. And so that's the inventory that they sold. And so their gross profit on that, you should know that from the income statement chapter, is $800,000. Now, industry experience and probably their own historical experience indicates that 10% of all sales will be returned. Now, we don't know which customer is going to return this. We just know on average, 10% is going to be returned. Now, what's 10% of $2 million? $200,000. Now, by the way, just before we skip to the end here, spoiler alert, we're going to get inventory back. So it's not only just, in this case, not just reducing revenues by that 200,000, we got to know that inventory is coming back. How much inventory? Well, 60% of the 2 million, the inventory represents 60% of the 2 million, or $1.2 million. So we know, hey, we're going to get $120,000 of inventory back. So that's what makes it a little complicated. So we're going to reduce the revenues by 200,000, but we got to add back the inventory back and reduce the cost of goods sold for the 120. Let's see how this works. Let's just follow. And this is how you should read the textbook, by the way. When, and the textbook has probably this exact same example, you should follow the journal entries really closely. And that's how you learn it. If you are confused by it, start over again, read the journal entry again, and go back and maybe read the verbiage in the text to understand this. So on the very first transaction, they recorded, they received cash of $2 million, and they credited revenue for $2 million. And their cost of goods sold was $1.2 million. Their inventory is $1.2 million. Now they could have gone ahead and reduced this right up front by 10%. But what they're going to do is do adjusting entries to get this right at the end of the year. Probably the way most companies do it. I think we did it every quarter. We couldn't wait till the end of the year, but we adjusted our refund liabilities, which we'll get into in a minute, every quarter based on experience. So we would do it similar to the way this example is playing out. In other words, kind of like the gross method, while they're recording the sales, they just let all the sales get recorded, and they record their cost of goods sold and all that as if there's no returns. And during the year, 2021, they had $130,000 of sales returns, and 60% of that was the inventory came back in. So this is really pretty much on a cash basis, so the inventory came back in, and they debited inventory, and they reduced the cost of goods sold, and then they reduced, credited cash, for that sales return, and because the customer wanted their cash back, right? So you got to pay them the cash back that they originally paid, and we're going to debit sales returns. And again, this is not a balance sheet account. This is kind of a contra revenue account. It reduces the revenue. We could have just debited revenues there, but we want to track. If we did that in the accounting systems, we would lose visibility to how much has been returned. So we use a separate account called sales returns, and it offsets the revenue. So when we do our income statement, we'll take revenues and gross minus the sales return account, and we'll have a subtotal called net revenues. Usually all you see on the financial statements are the net revenues. You don't see all the individual pieces behind it. Now, what's a problem with right off the bat? Sales returns have been 130,000. What do we expect? We expect 200,000. So what does that mean? There's at December 31st, we're doing the accounting for the year. Guess what? We've got an adjusting entry because we expect there will be $70,000 more in returns, because this 130 doesn't represent the entire 200,000, 10% of revenues that we expect. And unless something's changed, let's assume we still expect it to be 10% because it's always been 10%. We can't change that. And so we've got to come in here at year end, and this is an adjusting entry. And we're going to, debit sales returns, and we're going to set up a refund liability. And so, because we don't know who's going to return it, but later we're going to have to cut a check for cash, credit cash, and we'll debit this refund liability. So for these returns that are going to be in the future. So these are kind of like accrued refunds, a refund liability, a new account for you. Guess what? We also know we're going to get some inventory back. And we're not going to debit inventory. We're going to set up another inventory account called estimated returns. So we're going to want to track that separately than our physical inventory that we can touch and feel. This inventory is still, guess where it is? It's still it's kind of weird, still in our customer warehouses. But we know that based on our estimates, this inventory will be returned to us. 42,000. By the way, we sold them. There's 1.2 million that we sold, so that 42,000 is not much. And so again, we got 78 back already. We expect 120,000 that's going to be returned. There's another 42,000 left, estimated returns. Fun stuff. I know this is this is hard, but it's real. This is you got to be ready to do this type of accounting when you get into large and really successful companies have returns. And hopefully it's not more than 10% because they wouldn't be as successful. And then during the year, this is the next year. Remember, we're accounting for 2021. This is the December 31st, 2021 adjusting entry. And then later in 2022, guess what? The actual inventory, this has never happened, by the way. We'll see another example in I think the next slide. But the exact down to the last dollar we expected to return, not returned. There's always noise. It never is perfect yet. But this is assumed. This is a textbook example here. It all got returned. So now we're going to debit the sales return and credit the I'm in the wrong slide here. Sorry. I knew that was not right, but I did. So yeah, in this case, like I said, actually 70,000 got returned in what year? 2022, and that was a 70 that we had originally estimated. So what do? Now we're going to give our customers back their cash because they returned the product, and we're going to debit that refund liability we set up back in December 31st. And so we're all clean there. By the way, actual touch and feel inventory is back in our warehouse for 42,000, and so we can reduce that inventory estimated returns account back down. Now, here's a more realistic example that I was referring to. Suppose that we got our estimate wrong. Your estimates are never going to be that exact, precise, down to the last penny. It turns out that we did better. There was less returns than we anticipated. And that in 2022, there was only $60,000 in returns for those sales in 2021. By the way, people are celebrating, means maybe the product was a better quality, did a better job of explaining how it worked or whatever. There were less returns. That's an awesome deal. And so in this case, we had set that liability up at 70,000, and we got to reduce it down by 10,000, and we're going to reduce our sales return. So that was 70,000. So this is, by the way, income. Does that make sense? It's a credit to income or profit. Now it's a credit to revenues, which flows into income. And so, does that make sense? We got 10,000 income. Well, we expensed 70,000 last year, and estimating $70,000 in returns in 2022. We only got 60,000. So it's a $10,000 good guy, right? Good for the company, good for the investors in that company. So it's a credit because we had less returns than expected. Now, by the way, we're getting less inventory returns too. And so we're also going to debit cost of goods sold for this 6,000. The total profit for this entry is $4,000, not the full 10,000, because we didn't get all the inventory back we expected either. I think you've got to pull your textbook out. You got to spend time on this really to understand it. Next, nuance. Guess what? And this is the bad news. We don't collect all that accounts receivable. No, we plan to, we want to, but we're going to take risk. We're not going to sell to bad customers that we know are not going to pay us back. We're not going to do that. We have a credit department who evaluates all the customers, and they decide who they're going to allow to buy products from us. There's a lot of work around that. And then there's a lot of work trying to collect it from people who are not paying us, but bad things happen. And not everybody's going to pay us. And again, kind of like sales returns, we're going to, based on past experience, what percent of our sales, what percent of our receivables is not going to be collected based on bad experience. We don't know who, but we know some percent on average is not going to be collected. And so we have two methods, just, like the gross method on cash discounts. Well, who cares? We're just going to wait till they don't pay us, and then we'll charge it. Then we'll take that bad debt expense. Does that sound right? I hope by now, the accrual accounting, that doesn't work, because we got sales in this, we're getting sales in this accounting period because we're giving credit, knowing we're taking risk. So knowing that some percent of that receivable is going to go bad, we need to expense it, match it up with the revenues, that we were able to get because we sold with some risk on credit. And so the direct write-off method is not GAAP. I'm not going to cover it. There was a slide on it. I don't know why. I'm only going to cover the allowance for method. So in the allowance for method, we set up another account, kind of like that refund liability account, that is going to be the allowance for uncollectible accounts. I hope you remember this from Principles of Accounting introductory course. It's a really important concept. I belabor this with my Principles of Accounting students. And so if you were in one of my introductory classes, I hope you already know this. Don't need to spend time on it, but I will to a degree. That the allowance for doubtful accounts, by the way, has a credit balance, and we call it a contra asset account. Why is it a contra asset account? Well, number one, it's a contra to the receivables. It's an offset to the receivables. Any kind of contra account has an offset. It's also contradictory because all assets accounts have debit balance. Well, this has a credit balance because this is reducing our overall accounts receivable. Remember, in the balance sheet, we took the accounts receivable account minus the allowance for uncollectible, and that's what we put on our balance sheet. And I did mark off if people did not net those in the balance sheet on my exam. And so here is how it gets classified. You are required to disclose the allowances, and generally done here to footnote, and the net amount is sitting over here. So bad debt expense are not recognized when they're written off. It's estimated when we sell stuff, whether that's services or products. And so we estimate it based on prior experience. Here's an example. The Hawthorne Manufacturing Company, the same one we've been using here, had sales of $1.2 million, collections of $895. And this is its first year of operation. So its beginning receivable balance is zero. And so they sold $1.2 million on terms. So debit accounts receivable, $1.2 million, credit revenue. They collected debit cash, credit accounts receivable. Their ending balance is $305,000. Now we know not all of that $305,000 is going to be collected. So we got to figure out what to record. So in this case, they just give you the number. That's not how it's going to work for me. But they said, hey, we only expect to collect 280 of this. So this is the big entry you need to know in this chapter, and we will be doing problems on this in the next lecture. debit bad debt expense for what we expect not to collect, and credit the allowance. So in this case, the allowance start off with 0, in the credit for bad debt expense, 25,000, ending balance, 25,000. Then later, and then again, we're moving to the next year. We're just showing you the journal entries here. We'll do calculations of this amount later. So later, what happens is that we do everything we can to collect this account. You know, we'll probably get attorneys involved. Usually it takes more than the time frame here because we fight hard to collect that before we write it off. But eventually we decide, hey, the customer's gone bankrupt. They even legally, they don't have to pay us anymore because they've declared bankruptcy and they're out of business. And so now we got to write, now we do write the amount off. It's, you know, what do? We reduce the allowance, right? Because the allowance started with the credit balance, and now we reduce that for this customer written off, and we reduce the receivable. And you know, I'll probably talk about this when we when I do the problems, but there's only a few things that can happen only 2 things can happen in allowance for uncollectible accounts. Only 2 things. Credit for the bad debt expense we record, usually each accounting period, and debit for the amounts written off. The beginning balance, plus new bad debt expense for this year, which we don't have here, minus what's written off in ending balance. Well, guess what? There's 3 things that can happen in receivables. So you only, by the way, so you only need to know, there's only a few journal entries you need to know for this, for accounts receivable, but you need to know them really well, you know, because you'll be tested on those. In receivables, you have new sales plus credit sales, people pay us, credit minus, or we can write off accounts. In this case, here's the write off of 15,000. Okay. So we need to find a way to calculate who's not, how much, not who, we don't know who, that's a misstatement. We need to calculate how much we need to report as bad debt expense. How much of that 305,000 not going to be collectible? We know the balance is 305. We've got to find a way to estimate the future. That's you know, pretty hard to predict the future, but we have some methodology here. We can do it. Now, the FASB has come out with a new model called the current expected credit loss model. And so you have to evaluate really on a customer by customer and in order to forecast that. And we'll show you how to do that here in a minute. Well, right here. So here's one way of doing it. And we'll have a accounts receivable ledger. We'll have systems that provide this information. Every company does, even on a spreadsheet if you're a small company. It'll list how much everybody owes us. Then it's like wine. We're going to age it out. Is this, in other words, this 20,000, 14,000 of it is 0 to 60 days old. 6,000 is related to stuff we sold 61 to 90 days ago. So there's an aging out here. And so look at this 33,000. This is a good example here. Wow. And let's say our terms were 60 days. You know, I don't know if they showed that, but our terms are 60 days. They're past due on 20,000. They're way past due on 10,000, over 91 to 120 days. And oh, sorry, I can't see that because my face is in the middle of that. Over 120 days. Are they ever going to pay that? Doesn't look good, does it? And so we can age the receivables out. And then now we can do some good estimates, right? Now we got data. So this 220, 0, so we add them all up, all the columns from all the customers. And we know that from 0 to 60 days, we've got 220, 61 to 90, 50,000, 91 to 120, 25, over 120, 10,000. And then based on history, we can estimate percentage uncollectible. We know this stuff 0 to 60 is most likely going to be good. And that's only 5% uncollectible. But look at the over 120, 40%. By the way, I think that looks like a really low percentage, because in companies where I worked, that would be more like, I think we went out to 180 days sometimes. Over 180 days, 90%. You know, the chance of collecting it after 6 months is slim and none, you know, and so it could be 90%. So you use some history, and guess what you also use? Common sense, and you estimate this stuff out. And this is very logical. And this is how they calculated that 25,000. By the way, I don't care where you are taking intermediate accounting, you are going to have to be able to estimate this for your exam. And so will my students. And it'll be a really big deal on my exams. So here's another example. Oh yeah, so this is an example that how do we record the bad debt expense? Because this is a company that was already in existence. Their receivable had a balance of 400,000, but after all that analysis, they recognized, you know, we've done our aging of our bad debts. We need 40,000. And the reason I'm giving you a different company here, well, it's the same company, but it's in the next year. You want to go, you know, where there's a beginning balance. Otherwise, the example might confuse you. So we're using a different example here. So in the pre-adjustment balance, that's after the current year, maybe write-offs and everything else, the beginning balance for our adjusting entry is 11,200. So what do we need to record? We know the correct balance should be 40,000. So for this aging method, you know the answer. It's kind of like supplies. If you go back to the way we did supplies in the adjusting entries for chapter 2, we know the ending balance is 40,000, but the current balance is only 11,200. So what credit do we need to make 11,200 credit become a $40,000 credit? Oh, I need simple algebra. 40 minus 11,200, solve for X, 28,800. What's my journal entry? Debit bad debt expense for 28,800. Credit my allowance for uncollectible accounts, 28,800, and I get it to 40,000. So you could end up in a case where here, give you two different examples here. One example is you start with a debit balance, you know, prior to, they wrote off so many accounts receivable, they ended up in a debit balance. Not on the final balance sheet, that'll never happen. That's always a credit balance. But during the year, they wrote off so many accounts, they just kept debiting, and the allowance for doubtful account, I say doubtful account, allowance for uncollectible accounts has got a debit balance. You know, we know, number one, that ain't right, but we need to get to 40,000 credit. So what credit is going to take a $2,000 debit balance to a $40,000 credit balance? It needs a bigger credit than, you know, 42,000. And so when we debit bad debt expense for 42,000 and we credit the allowance account for 42,000 here, we say 2,000 in debits minus 42,000 credits. I end up with the $40,000 credit balance, and that's what I want. That's what it should be. Now, here's another really interesting situation. It's kind of the opposite situation. So they had a balance of 11,200, but we did all of our work and we realized we only need 5,000. This just shows you that it's not always debit bad debt expense credit the allowance. That's the normal typical journal entry. But here we actually have too much in the allowance account. Our analysis shows us we only need 5,000. Guess what? We're going to debit the allowance account and here's a weird one. We're going to credit the bad debt expense. Usually expenses are debits, but here we're going to credit bad debt expense, meaning it's going to be like income. because it's a credit on the income statement. Does that make sense? Well, it tells us, it reflects what's happening in the business, because maybe what we estimated for bad debts was too much. And we've done based on all history, it was right at the end of last year, but maybe we hired a new credit manager. That's what I would have done, hired a new credit manager, better at collecting, better evaluating customers, and we have less bad debt, going forward. And so there's actually a debit. So, but the point being on both of these, we're going to know the ending balance and the beginning balance. That's what we're going to know. That includes multiple choice on the exam. What solve for X? Do I need a credit, like in this case, or do I need a debit to get to the ending balance? So the aging method gives you the ending balance. Now, some companies, they don't use the aging method. I believe the aging method is the only way to go. The balance sheet method is the appropriate way. Some companies, and I don't think it's even this income statement approach is not allowed anymore without some evaluation of the ending balance because of the new CECL model. So, so one way to do it is say, hey, I'm just going to use percent of sales method. I just look at my sales for the year and I multiply the percent of sales times that number, and I book bad debt expense. Now, what's the problem with this? Boy, this allowance for uncollectible accounts just keeps building. How do you know it's good? At some point you got to stop and do something like the agent method to see that it's good. And so here is that exact thing. I'm gonna skip by this slide here. Yeah. So even if you use the percent of sales method, eventually you've got to evaluate your accounts receivable under that CECL model that the FASB has out, and evaluate how much is collectible. Because if every year just booking percent of sales, bad debt, and your allowance is growing minus the write-offs, what's in there? At some point, you got to evaluate what's in there to see, does it represent the amounts right now that I don't think I can collect as my contra to my receivables? And so that takes some analysis and work on the balance sheet side. You can't just use the income statement method any longer by itself. But it's good to know some companies still use it. Okay, switching gears. Now we're going to talk about notes receivable and how do they differ from accounts receivable, formal credit agreements. And what's going to be formal means usually written, expressed, and there's a creditor, which is who's lending money to the debtor, the borrower, and they could be less than a year or more than a year, and they're going to have an interest. Accounts receivable does not have an interest component. Notes receivable will have an interest component. And so, companies receive cash or product here, and they're going to have to pay later both the principal, the amount of the note, plus the interest for that note. What's the interest? Base amount of the note times the annual rate. And interest rates are always annual rate, and then you have to multiply what fraction. So if it's a 6-month note, you would take base amount times the interest rate times 1/2, because 6 months divided by 12 months. And so you'll calculate that out. Key deal being there that interest is always an annual rate. So here's a $700,000 6-month 12% note. Note that this one doesn't cross over a year end. So it's May 1st and the payment is November 1st. So we're not going to cross over a year end and record an interest receivable. We're just going to right off the bat later. And this is how much interest is going to be? 700,000 times 12%, that's 84,000. Divided by half, 42,000. If the note had been outstanding a year, then 84,000, but it's only outstanding 6 months. Every day it's outstanding. Every day you're using someone else is using your money, which is the case here. You are recording income. That company recording expense, but you are recording income interest. And so here, at the end of the 6 months, we get the principal back, the face value back, 700,000, and we also receive the interest, 42,742. and we debit the note for 700 when we uh, sell the product to them for a note, and then we credit it here where we receive cash, and we'll also credit interest revenue for the cash received. Now, same example, but what if you pass over a year end? Now you need to go accrue that interest, and so you would have a credit interest revenue for 5 months out of the year and debit the interest receivable. Usually what I like to do is go calculate it by month first. So 700,000 times 12%, $84,000 a year. Divide that by 12, 7,000 a month. So every month that's outstanding, the company's earning 7,000. How many months has it been outstanding? August, September, October, November. I usually count on my fingers. 5 months, 5 times 7, 35,000. Now, there's only 1 month in the next year, and there's another 7,000 as you would expect. And so now in the next year they get paid the whole 742. There's going to be a credit to the interest receivable that we set up at December 31st, and now we have that final 7,000 of interest. Why does it work like this? Well, we earned that 35,000 in 2021, and we need to make sure our income statement is correct. This is just, remember, adjusting entries get your financial statements correct. It gets both the balance sheet correct because people owe us 35,000, and it gets the income statement right because we earned 35,000 last year. If we put all 42 in February, it's going to be wrong, right? Because we didn't earn all 42,000 in 2022. We earned 5 months of it in 2021 and another month of it in 2022. I would say for notes receivable, we still have to apply the CECL model. We have to see is all this collectible, and we'll use different methodologies similar to maybe what we did for accounts receivable aging, but there'll probably be some other information, because these are longer term notes, maybe some macro information that we're going to look to and see how much of these notes receivable we're going to collect. So some of the notes could go bad as well. Next subject, next nuance, if you will. Guess what we can do? We've got all these receivables. I've been in companies, we did this at Lennox, we did this at Maytag, to a lesser extent, we did this big deal at Lennox where I work. But we can get financing for our receivables. 2 ways. One, we could just sell the receivables. Hey, give me cash and I'll just give you all my receivables and you go collect them. Who would do that? Financing companies. We just want to be out of the game. We don't need a credit department. We're just going to sell all these receivables off. You go collect, it's your money. And we'll look at it. You can sell it with recourse, meaning if they don't collect it, they come back at you, or without recourse. You got the risk. Now, obviously, you're going to receive less cash if you're going to give them the risk of collection. Another way we can do it is kind of like a mortgage on your house. We can use the accounts receivable as collateral to stand behind money we're going to borrow. So we can borrow money and then pledge the accounts receivable or assign it. We'll look at that there. And so it's just another really way of having debt. Now, by the way, the accounts receivable stays on your books, as we will see given that. So when companies pledge accounts receivable, just mainly just talk about the terms here so you learn them. We're pledging the whole balance, not individual receivable is really associated with this. And that's against assigning, we'll assign specific accounts receivable that companies are borrowing against. So in other words, for both of these, if we don't pay back what we're borrowed, then they take the receivables legally. Now the sale of receivables, sell receivables, we're going to remove the receivables off of our balance sheet. It's just like selling any other asset. And and then we'll record the difference as a gain or loss. And so how much we sell them for. If we sell them without recourse, the seller cannot ask for more money back. With recourse means we the company selling the receivables, we could have some problem. And so we need to really maybe record a small liability for that possibility when we do that. Now, the FASB, there's a lot of, you could not imagine all the number of transactions that happen around accounts receivable. A lot of commercial paper that's in our cash equivalents from the very beginning of the chapter is supported by pledged accounts receivable and different things. And so it becomes packaged. There's a whole bunch of securities around this. And so, and some of it gets very complicated. So the FASB set up some rules that you must meet before you can take the receivables off your books. In other words, most companies want to record this as a sell. So the receivables are off our books and the debt's off our books. It looks better financially. You don't have the asset, but you don't have any kind of liability associated with it either. And so companies like that answer to their balance sheet looks cleaner, if you will. And so here are the rules. Transferred assets must be isolated from the transfer, that whoever sold these, they can't get access to these. The person buying the accounts receivable has a right themselves to pledge or sell the assets, and the seller does not have effective control over these transferred assets. And so those are the three rules. And so I'm not going to spend a lot of time on this slide, but does financing arrangement meet all three conditions for treatment as a sell? So those are the three things. Generally, I'll say secured borrowing, no. Receivables stay on the books. Seller receivables, yes. Now with recourse, there could be some question marks there. If you're in a company doing this, there may need more work. But if you sell it without recourse, clearly the receivables come off your books. That's easy. Some of these recourse situations become problematic, but you could recognize a recourse, liability, and then reduce either smaller gain or greater loss on that, and then still take the receivables off your book. But again, you still have the risk of collection. So finishing up here, disclosure. There's a lot of disclosures required, especially around selling receivables. Boy, a lot of detailed disclosures required. We did have secured borrowings around our receivables, as I said, at Linux, and we had a lot of disclosures around this. And we sold through at SPE, so it did turn out to be backing for commercial paper, I assume, for banks. I think this is near the end here, if not the very end. Again, we have balance sheets and income statements. Now we can do ratios. And so very interesting ratio. I think here we track this like religiously in all the companies I was at, and kind of manage the credit department on how they were collecting. But it's you're really going to get to how many days of sales revenues are sitting in your accounts receivable. If you knew how many days, let's say your terms were 60 days and you have 80 days in your accounts receivable balance, oh man, why do we have 20 extra days there? Because you're collecting that cash, it becomes cash, right? You can borrow. If you're collecting your cash earlier than the 60, you have to borrow less money. There's real financial implications here around receivable balance. And so now we can go calculate here the days. So how do we do that? First, you calculate the receivables turnover ratio, and that's just net sales divided by the average receivables. And so if your receivables, let's say this was 6, right? And I'm going to use 360 versus 365. If my net sales are 6 times more than my receivables, then I can come back and say, divide 360 days by 6. I would know there's 60 days in receivables. Could we just take the number of days in the year divided by that turnover, and you can get to your average collection period. Let's look at some examples. Here's Symantec and CA Incorporated, and their accounts receivable. It is the end of each period. We're 649, 556. So they're 2-year averages, you want to get the average balance. It's not, we're 603. In this company, the average was 695. Their revenues were 4019. I guess that would be 4 billion and 4,036 million here. And so let's just go calculate 4019 divided by 603. The turnover for this company, 6.67. The turnover for this company is fewer times. You want a higher number here, quicker turnover, so less days, 5.81. The industry average, though, is 8.38 times. So now you can get some information here to see how well these companies are managing at least their receivables, which could give you some more information about how they're managing other things. So then you take 365, divide that by the turnover. So this company has 54.7 days in its receivable. This company has 62 days. So they're not collecting as fast. And the industry average is 43. Now, if I was a CFO of one of these two companies, I'd want to go talk to my sales guys first and say, hey, our terms are too high compared to the industry. Why do we have to give 60-day terms? Now, having done this many times in my career, I'm going to tell you what the sales guys would say. Yes, but look at our revenues. We're selling more. we have to give these terms. Our customers are not going to buy from us if we don't have higher terms. Well, I'd want to go look at the financial statements of these other companies. I want to try to verify that if I could, but it's all really a negotiation and a discussion. But if you can reduce your terms from 62 days down to 43 days, that means your receivable balances is going to be lower. Means you're collecting more cash and you would borrow less money. So it becomes very, very real. And if you have more cash on hand, by the way, you can invest more in your business, buy more factories, restaurants, whatever business you're in. Okay, this is now, I think, the end. And we've got to be able to do bank reconciliations. I do have a YouTube lecture that's just purely on how to do a bank reconciliation. So I'm not going to spend a lot of time on that. You can look for my bank reconciliation lecture video, and I do 3 or 4 different bank reconciliations. Why do we do bank reconciliations? Because at the end of the accounting period, we have a bank balance. We look at our bank statement and we look at our books. Guess what? Both balances are wrong. We're missing things. We're missing things in the books. Why do we miss them? Are we just stupid? No, we didn't know about them. Why is a bank missing them? They didn't know about it. So now we're going to add and subtract all the things on both sides that if they'd known, they would have had a different balance, and we'll come down. Why we say reconciliation? And when we find everything out that's missing on both sides, we'll come down to the real number, the right number. And that will be what shows up on our balance sheet. And again, so there's adjustments to the balance, and the bank issues are mostly timing differences. You know, and the book balance, there's going to be things we're going to find out on the bank statement that we didn't know. So let's see here. I think this is a better slide. You can look at this in the textbook or you can read this, but I think I'd rather just talk to it. So again, I always say when we're doing a bank reconciliation, what's missing when I look at the bank side, and then is it a plus or a minus? And then that's just common sense. So one thing that's missing on the bank side are deposits. The company has gone down and made a deposit in the bank of cash, but the bank statement doesn't recognize it yet. Why? There's a lag. It takes time. Even if you go into a bank, sometimes they say anything received after 2 o'clock today is reflected on tomorrow's balance. And so even banks used to have signs in the lobbies that do that. The other thing that checks the banks is missing, we may have wrote a whole bunch of checks that are in the mail or floating around. Now, by the way, both these deposits and the checks, they're already in the book side. Why? We knew about them. We did journal entries as we deposited that money. We did journal entries as we wrote checks. And then there may be errors in the bank statement. And how will we find these errors? By doing a bank reconciliation. This is an internal control to make sure that we fix those errors. Those errors could have been a plus or a minus. Maybe they didn't, we'll find bank errors. My wife has found bank errors, and I think they were always not in our favor, so we got money back. So maybe it's good to do a bank reconciliation, even on your personal, bank. Okay, and then let's go to the book side. We got a little hourglass there, meaning that hopefully the internet was not going too slow there. So these are things we're going to find out by looking at the bank statement. Sometimes a bank, great companies, even good companies, they do not collect accounts receivable. They give their customers, that's how all my companies did, a PO box, and the checks go to this PO box. Guess who PO box that is? It's the bank's PO box. And they take those checks, and it just cuts out a step of that check going through our company and getting lost, getting messed up. And it goes right straight into the bank, and they give us credit for that directly. And then they send us a note of what customers paid us. And so, by the way, that's why I hated cash coming into my department. We would call companies, say, don't send checks to our address, send it to the PO box we gave you. And we don't tell them that's the bank's PO box, but that's what it was. And so we're going to look at the bank statement and see how much money they collected for us. And we're going to, everything on the book side, by the way, we have to write a journal entry for, because we were missing these things. The things the bank's missing, we got. They're not missing on our side, but so we don't need to do journal entries. Everything over here, we got to do journal entries. By the way, maybe they're charging us some fees for whatever reason. That shows up on a bank statement. We got to record those as expenses. NSF checks. What does that stand for? Insufficient funds. Means we collected a check from, this is terrible, but we collected a check from a customer. We submitted to the bank. The bank's telling us that customer did not have enough money in their bank account to pay this check. Insufficient funds. We're not giving you credit. So they're not giving us. They did not do a plus for that check. In our books, we got a plus for that check because we thought we'd received the cash appropriately. And so now we got to do a journal entry to subtract that. What else do you think we got to do? We got to call that customer. You gave us a bad check. Come on, pay up, so, and we might want to stop even shipments to this customer until we find out what's going on, because maybe there's something wrong that's going on and they're not gonna pay us. And so, and we also find errors on our side. Maybe we recorded a check as 2,000 and it should have been only 200. Sometimes somebody fat fingered a journal entry or something. The fat finger means they were going too fast and they put 2,000, got an extra zero in there, then 200. So we look at the bank statement, see that it's 200. We go back and look at the supporting paperwork, say, oh, it was our mistake. We deducted 2,000. We should have only deducted 200. Why does it say plus or minus? In that case, we got to add back 1,800. We got to do a correcting journal entry. And after we do all this work, we end up with the same balance. They must be equal. And guess what? We know that is the correct balance for cash on our financial statement, on our balance sheet. So this is a bank reconciliation, really important. And if you're not doing bank reconciliations, that's going to be an internal control weakness. And when I was at Maytag, we had operations all over the world, and I was worried that people were not doing bank reconciliations. So this is crazy, but I think one morning, I know it was different time zones all over the world, but I said, hey, I want you to give me your bank reconciliation by this afternoon before you leave work for the day. And if you don't give it to me today, I'm going to assume you haven't done it, and that's going to be a problem for you. I was a corporate controller, and so now we had fax machines back then. So I was getting all these faxes from all over the world all day, and I think it was about 3 or 4 feet tall, because they give me the bank reconciliations and all their supporting work. It's about 3 or 4 feet tall, and it was in Portuguese and Spanish and Chinese, and I did look through it. Unfortunately, I didn't speak those languages, but the only people I went after and challenged were people that didn't send me anything. So what's going on? Are you not doing your bank reconciliation? And there's a couple people said, well, yes, I'm late on it. I said, well, come on, get it done. And so one thing I did to kind of check controls. And so, yeah, that's again, bank reconciliations an important internal control. You could find some fraud, but main purpose is to make sure you get your cash correct on your balance sheet. And when you're doing journal entries, on the book side, go back here, all of these, everything on this side becomes a journal entry. Then you are correcting cash, but you're also correcting maybe some income statement line items and some other ones. And so with that, I do thank you for bearing with me today. Appreciate your time, and hopefully this lecture was helpful for you.